What's up, YouTube? Welcome to my next video in this series we have going on here. I promise you're not watching the same one. I know I start every video with the same sort of intro style. But today we're going to be talking about something new. It's an investment asset that has relatively recently come onto the scene. And when I say new, I mean new. I can tell you, I've read tons of books. I have more idiot's guides to investing than I can count. And this is one thing that's not really covered in those books, and that's why I sort of left it out of the Investment Assets 101 video. And before I let you know, though you've probably already read the title of the video, so you know what I'm going to talk about, I'm going to tell you to like and subscribe. Don't forget to like and subscribe. Be the first ones to see new content when it gets out on YouTube, and I look forward to you looking at some more. So with that being said, we're going to be talking about peer-to-peer lending today. Like I said, this is new in every sense of the word, and it sort of has to do with the fact that it's one of those investment assets that's almost entirely through online banks. I don't think I've ever seen any traditional investing house specialize in peer-to-peer lending. Now, peer-to-peer lending is a little bit different. It's very much like traditional loan services where you can go and apply for personal finance loans for anything from debt consolidation, vacations, house renovations, what have you. Now, the interesting thing about it is like a traditional loan. You can go in, you apply for this loan, you can get your money. But on the flip side, is the interesting part is how these loans are actually funded. Now, typically these are banks that will issue these loans. However, the banks act more as intermediaries. And that's because the funding for these loans comes primarily from other individual investors. Now, this is a cool concept because it means that a typical investor or borrower could be the same person. You could take out a loan, you could have loans of your own, and at the same time you could fund other borrowers' loans. And the idea with that is you can make money off of gaining interest on whatever money you put towards a borrower's loan. Now, like I said, these are usually facilitated by intermediaries, and these typically tend to be banks or organizations that would otherwise be accredited by financial oversight authorities like the SEC. Now, one interesting thing to note is that even though some individual investors may be partially funding these loans, it can also be organizations, charities, or actually other banks funding bits and pieces of this loan. Now, what's also interesting is that these intermediaries facilitate peer-to-peer borrowing because it sort of eliminates some overhead for them. So if they decide to take part in some of the lending process, they can make a little bit more money and they can pass on that savings in terms of higher returns directly to individual investors. One last thing to note about these financial intermediaries that will actually connect the borrowers to the individual investors is that the financial intermediaries will actually handle almost all of the administrative duties with servicing the loans, keeping up with the payments, notifying the individual borrowers, and on the flip side, notify the individual investors on the performance of their loans. Now, specifically for you, how do you get started? Well, there's a handful of different companies which will act as these peer-to-peer lending intermediaries, and I'll talk about those in a little bit. But what they'll typically do is they'll have a portfolio of loans, typically hundreds, thousands at a time, that they will actually divide up among varying categories of risk, which will also correspond to a category of return, and allow you to break up whatever investment you want among any number of different loans of varying returns and risk categories. Now, why is this sort of beneficial for an individual investor? Well, like I sort of harped on in previous videos, diversification is key in investments. What it allows you to do is break it up among higher risk and higher reward loans and balance that with lower risk and potentially lower returns. Now, all of the intermediaries I'll talk about in a second basically allow you to sort these loans by creditworthiness. And the way it does that is it doesn't tell you the borrower's credit score, but instead it will actually assign it sort of a letter grade or a category, which can roughly correspond to a level of risk that you may be comfortable with. And it does this by looking at income to debt ratios, outstanding debt, the reason for the loan, and the amount of the loan as well. Now, while you can make money, you have to keep in mind that almost all of these individual peer-to-peer lending loans I've seen are actually unsecured loans, which means there's no collateral to back them up in case the borrower decides not to pay those loans back. Now, what does that mean for you? Well, if a borrower falls behind on payments or stops paying on a loan, there's no collateral for the financial intermediary to collect and pay back to you. So that can equal a chance of default. But generally, the intermediaries I've seen have avoided lending to lower creditworthiness individuals, and that translates into a little bit more security for your individual investment. And after all, whatever interest you're making on these loans, especially if you've diversified properly among all the different categories and just sheer number of loans, by and large, your interest return will vastly outweigh the number of loans which default. Now, one parting thing to talk about is these organizations which actually do offer these loans. The two I've heard of primarily would be Lending Club and Prosper. As I might have mentioned in a previous video, I personally use Lending Club. Lending Club allows you to take your initial investment and break them up into $25 chunks known as notes, which will go and partially fund these loans. Now, Lending Club also gives you a number of different tools to assess the creditworthiness of these individual borrowers, and that could be a deciding factor in if you decide to fund a particular loan or not. Or you could go on easy mode and do an auto investing tool, which Lending Club also offers, among a number of different creditworthiness and returns, potential returns on these loans as well. Now, this is actually going to be the end of the video today. Hopefully this was a quick, short one that I could just, hammer out, get out there, sort of wet your feet. I encourage you to do a little bit more research. I know what I've talked about is a little bit bare bones, but there's no real numbers or charts I can really throw at you today. It's all speculation and would vary widely on what your asset mix is in terms of creditworthiness and potential return for these loans. So that being said, as always, like and subscribe if you like the content. Be the first to know when something new comes out. And I hope you look forward to some of the new content I'll be putting out in the future. So now I know what you're thinking. This video just ended, didn't it? Well, not quite. There is one very important thing about peer-to-peer lending I forgot to mention the first time I was filming this. So I come back on day 2, another day, just to let you guys know. And it's really important just to remember that since these are loans that you are funding, that funding for those loans will be tied up until the loan is completely paid off. That means you will get pieces of it back as the principal is paid back, but for all intents and purposes, especially if you continually reinvest that principal back into new loans, it's going to be tied up and is going to be very illiquid assets. So it's just something good to know. On the flip side though, like bonds, and again when I go into the video about bonds a little bit more in depth, it'll sort of shine a little bit more light on peer-to-peer lending because they function very similarly. There are secondary marketplaces where you can buy and sell loans, crowdfunded loans, and peer-to-peer loans that are in progress. So in that respect, you do ditch a little bit of the illiquidity, and you can sell those loans if you think they're going to go bad. But at the same time, there is going to be a cut if you sell a loan prior to it going to completion and being paid off. So that's it. Like I said, just something I need to come back and wrap up. But that's it for me, and thanks again for watching.